You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
Another day, another podcast. Hello, I'm Don McDonald, along with my good buddy and co-host Tom Cock. And he's there, see? And welcome to Talking Real Money. We are here to try to help you make money make more sense so that you can make more money. And we're trying to make it easy for you, too, because everybody else out there is trying to make it really hard for you. So remember, you can call us with your questions at 855-935-TALK, or you can send them in at talkingrealmoney.com, and we'll have a couple of those coming up later in the hour. But first, we want to talk about something that's been getting some press lately, and that is the supposed demise of the good old-fashioned 60-40 balanced portfolio, because, darn it, interest rates are just too low for that to work anymore.
Well, yeah, and stocks aren't going to make you enough, et cetera, et cetera. So 60-40 refers to the asset allocation, right? 60% of your money in stocks, 40% in bonds. This has been a very traditional, like, balanced index fund or balanced portfolio. And we've kind of been out there saying for a long, long time, look, we don't know you, but if you did a 60-40 and you only took out 4% fixed plus inflation or 5% variable, your money lasts a long time. So I'm always fascinated to read these pieces in our trade magazines that say, nope, doesn't work anymore. Time to rethink the traditional 60-40 retirement portfolio. Why? Well, Don just mentioned one reason. Low interest rates. So bonds aren't going to pay you enough money.
Right. So now you need to get into high yield bonds or emerging markets debt. We did a podcast on
so
that,
you could make 4 to 5% of your fixed income while hopefully your stocks still make enough. Mm-hmm. Now, what they forget to tell you here is when you add high yield bonds, emerging market debt, there's all kinds of junk that they want to sell you into, that you're taking quite a bit more risk.
In fact, because if you're taking risk that's similar to the stock market.
Thank you. I was just going to get to that. In other words, you're adding to the 60. Most people get to retirement. They don't want to see their portfolio fluctuate, right? Like my weight at the they prefer it to be more steady. They don't want to see things move around as much. So let's just unpack this a little bit. Number one, I think the bigger takeaway is just what I just said. If you are inclined to do this, to take more risk, well, then you need to rethink your risk-return profile, right? Because if you're going to pile into high-yield bonds, really, or emerging markets bonds, I got a lovely 100-year Argentinian bond I can sell you. But here's you're taking on more, you're signing yourself up for more volatility, or at least that's what it's been in the past, right? No question.
Yeah. They're pretty sure it's going to be that way in the future, but no guarantees.
Okay, number two, you can't generate enough income. They're looking at this the wrong way, because here what they're saying is your portfolio is not going to pay you out enough because the 10-year bond's paying 1.5 or whatever, something in that area, right? But that's not the way to look at this portfolio. The right way to look at the portfolio is growth from stocks and ballast from bonds. And the idea here, I think, is at the end of each year, or whenever your birthday, whatever day you want to do it, or if you're working with a professional, they'll do it better than this. You rebalance the account. As things go up, you sell those, either put the money in your pocket to pay your income for retirement, or put it into the things that have gone down. That's the way to generate the income. So you're not relying on interest from bonds. You're really not even technically relying for income from dividends from stocks. That's all part of the portfolio. You're rebalancing. You're taking the money off that. And looking back, Don, I hate people look into the future because nobody knows starting tomorrow what the future is going to look like. It's an outrage. But looking back, this strategy has worked fine for a very long period of time. In fact, when we run the numbers, even in an all bond portfolio, we can't run you out of money if you use a 4% fixed withdrawal. Sure, it gets low, but we can't run you to zero.
Well, we can't. Oh, with a fix, no. With a fix, no.
Right.
No. And you
Exactly.
know, it's funny. Christine Benz, just recently, I think like yesterday, wrote a piece at Morningstar about just that. How if you take the 4% with the inflation kicker, that in a low rate environment, you can easily run out of money. But she said with a flex, she didn't call it that. We call it a flexible withdrawal. She called it some other things. But with a flexible withdrawal system where you take out X% of the portfolio at the beginning of the year, and that's what your budget is for the year, it's really hard in that 4, 5, 6% range to run out of money before you run out of life.
By the way, anytime people say, here's what the future is going to look like, gets my hair up. Number two, anytime people tell you, you got to sell this and buy something else, figure out why they're telling you that. What is their incentive to get you to move? Remember, money in motion creates money for Wall Street. Number three, Christine Benz, since you mentioned her, she's the person that gave me the quote I still absolutely love when it comes to retirement income, and that is the only withdrawal rate we'll really know is the correct one is after you're gone. Then we'll know.
Then we'll know. Yep. Couple of questions sent in to us at talkingrealmoney.com. You can also call them in at 855-935-TALK. This one's pretty short, Tom. Subject's 401k. Our income is lower because of my wife's retirement, and we think it might be a good time to move some 401k money into a Roth. Should we keep the money in the 401k or move it to an IRA?
Wow, that's going to basically depend on the options in the 401k plan, which should be the same in the pre-tax as the post-tax, and the costs that are associated with the 401k, both in terms of the assets and in terms of the management of the 401k, which are often hard to get to. Those would be the factors that I would look at. Otherwise, and by the way, not every plan is going to let you take money out of the plan while you're still working. Some will, some won't. And most of the time you have to be 59 and a half. And he didn't say how old he was. But so it depends, I guess, is the correct answer there.
Yeah, the things, if you can move it, then you really need to determine the quality of the investments in the portfolio. If they've got a lot of very good, broad, diversified index offerings at very low costs. If you can get broader diversification and lower costs outside of the 401k, then that's a no-brainer if you're allowed to do it.
Yeah, indeed.
Next question, sent into talkingrealmoney.com, tax advice for charitable contributions. You guys always say that no one can predict the future. Well, I'm certain that I can. I predict income taxes will go up. I'm not certain about when exactly. I don't even know that for a fact. I don't pretend to even know that.
I don't think that's a fact. I think if I was a betting man, I might take that bet, but I wouldn't say it's factual.
I'm not a betting man, so I wouldn't even take that bet because who knows? Some people's taxes might go up, but mine might not. I don't know. Particularly when I'm in retirement, I could have almost nothing. Depends on how my investments do. I'm retired, living off a pension and a modest dividend stream trickling from my stock and bond investments. I have not yet reached RMD or SSA FRA, Social Security full retirement age, both of which will kick me into a higher tax bracket. I always give to charity. In 2020, I gave much more than usual because so many people are hurting so much. As I start to work on my 2020 tax return, I wonder if I can plan charitable giving more intelligently in the future, assuming a hike in income taxes. I think you can take that part of the sentence out, just intelligently in the future. Would you be willing to discuss the ins and outs of charitable contributions through donations of appreciated stock? I get a modest dividend stream. The gifts should gifts best be confined to non-dividend paying stocks? What about charitable remainder trusts? I try to read about it, but they seem complicated and for super rich. Are donations to charitable remainder trusts practical for people with $1 million or $2 million in lifetime investments? I suspect I'm not the only one wondering about this.
There's a lot there, by the way. So there's a couple of different parts of all this. Part one is if you give money from your qualified accounts, right? Your IRAs, that kind of thing. That would be the I always forget QC. I always forget the
I forget
qualified
retirement something. Yes.
I have to look it up, but I mean, there's a way to give money right out of that IRA that then you don't have to pay tax on it, and that qualifies for your required minimum distribution. That can make a lot of sense. In terms of money post-tax, and I hope you're looking up the name, Don, because I feel bad that I'm. When you give away the
QCD,
money from
a qualified
QCD,
charitable distribution.
Qualified charitable distribution. So that can be one way. That's pretty easy, and you don't have to be rich to do that. You could give away whatever amounts you like every year, and that would take the place of your RMD, saves you on your taxes. Then there's the post-tax money. Now, you mentioned appreciated stock. I think this makes a lot of sense. For people that I bought Microsoft in 1995, and I don't want to trade out of that because it's going to have this huge capital gain. Then each year you could give away a certain amount, right? Because that's appreciated stock. The charitable organization doesn't care because they can simply sell that, put the cash to work, and they're not going to pay any tax on it. I hope that answers your question.
Yeah,
but,
and charitable remainder trusts. There are a number of simple charitable remainder trusts. You don't have to have expensive attorneys and all. In fact, some of the brokerage firms like Schwab do charitable programs in which you can deposit securities and withdraw the dividends, and they're still earmarked and they've been given to charity. So
yeah, that's true.
There are a lot of ways to do this, and they're not all that complicated. So you might want to get with the firm that handles your money and see if they can help guide you toward the better answer. But yeah, I love the idea of giving if you're going to be in a higher bracket, you don't need the money. Giving your RMDs to charity is a really great way to go and saves you a bunch in taxes. So
we've done that for many, many clients, and they commit the money to places that are important to them on a wide scale of charities and not-for-profit organizations. It's great for both parties, frankly.
Thanks for your question. And if you have any, send them in to talkingrealmoney.com. Type them in, record them there. There's a little microphone button. Or you can call 855-935-TALK 24 hours a day, 7 days a week, and leave your question there. We love hearing from you. We really want to help you out. Thanks for listening to the podcast. Tell your friends, acquaintances, family members, enemies even.
People on the street?
Yeah, they just wander down the street saying, Talking Real Money, Talking Real Money. They'll think you're crazy, but maybe they'll get the message. It's subliminal.
You're not supposed to call them crazy. That's
nuts.
Sorry.
Okay, they'll think you're nuts.
Okay, that's better.
Is that better?
Yeah.
Yeah. Off your rocker? Loony? Loopy?
Yeah, we're not.
Am I digging a deeper hole?
It's not getting it better. Let's put it that way.
Thanks for listening. That's Tom Cock. I'm Don McDonald.
Talking real money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.